the bullion banks run short paper, structurally, unallocated credit gold. So the only way gold could be of systemic threat to the stability of the Western banking system is if the price of gold rose really high, really fast. A reset. And so here you have in 2021, by 2022, Western banks were being told by Basel, get on sides, get out of your unallocated credit gold positions. Gold's going way higher. Now you've got the Chinese getting their citizens, get out of leverage, get into physical. But I think what the Chinese are telling you is gold's going way higher, get out of the way. And I don't know about 3 months, 6 months, 12 months, 18 months, 12. It's coming.
The shift from paper gold derivatives to physical bullion reserves is triggering a seismic transformation across global financial markets. As central banking authorities enforce stricter capital standards, structural shortages in paper markets threaten to spark an unprecedented repricing of hard assets. Lukegromen, founder of macro research firm FFTT and a prominent financial strategist, contends that regulatory overhauls are quietly positioning physical bullion for a major breakout. He points out that Eastern institutions are actively guiding investors away from leveraged credit gold and directly into physical metal. With Western central banks urging financial institutions to exit unallocated paper gold positions, physical gold prices are projected to move significantly higher within a compressed timeframe of 6 to 36 months. Gromen predicts that the Dow-to-Gold ratio will plunge dramatically toward historic lows, driven almost entirely by gold soaring rather than stock market crashes. Furthermore, as Western Treasury bond yields reach unsustainable levels, central banks will eventually be forced into yield curve control, sending gold to extraordinary new heights. Now, we present the clips from Lukegromen's interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
I think it is what they are doing is some version of what the president of the Shanghai Gold Exchange, I think his name was Zhu Luodi, said in 2014, which is, the gold market is, consumed in the East, priced in the West. Makes no sense. When China has a right to speak in the global gold market, gold's price will be revealed. That's what he said. You can go back to U.S. declassified State Department documents from WikiLeaks in 2009 from the U.S. Beijing Embassy, which says that China's official media is saying China is buying and adding to gold reserves to kill two birds with one stone. The U.S. and Europeans have always manipulated the price of gold using paper unallocated gold contracts, gold unallocated credit gold, to control the price of gold in order to support their currencies. China reserving more gold, basically calling BS on the manipulation and taking as much cheap gold as they'll sell, will bolster the internationalization prospects for the renminbi and strengthen China's FX reserves. Kill two birds with one stone. Then you go to 2009 in the BIS white paper we briefly referenced before, where the PBOC said, we want a non-credit-based neutral reserve asset tied to commodities. That the John Maynard Keynes proposal of Bretton Woods was probably the better idea than the one that was ultimately chosen, the U.S.'s Harry Dexter White proposal. And so when you put those three things together, what Zhu Luodi said, what the Beijing embassy in the U.S. said the Chinese official media was saying 17 years ago, and what the PBOC said in 2009, layer in what a PBOC official said in 2015, where he said, look, we want to internationalize the yuan. The mark of an internationalized currency is the ability to invoice oil and gas in yuan, and we're using gold to do that. Said that at an LBMA conference in Singapore. When you put all four of those things together, it's crystal clear, I think, what they're going to do. Now, is this it, right? This is the moment. But basically, I think when you look at what they're doing with these moves, they are getting their retail people out of paper, out of leverage, into physical, unlevered physical, which tells me they think the price of gold is going to move a lot higher in a relatively compressed period of time. Let me add one last thing to this. In 2021, net stable funding ratio, NSFR regulations under Basel III were updated which made it uneconomic for Western banks to hold unallocated credit gold positions. Alistair McLeod did a great piece on this in 2021. You can find it online. In it, he said that the only reason you would do this from a banking regulation standpoint is that the regulators see the unallocated gold market as a threat to banking system stability. And actually, it kind of alluded to, if it didn't say that outright, it alluded to exactly that in the BIS white paper, the actual regulatory write-up. My comment at the time, which I wrote for clients 5 years ago, which is the bullion banks run short paper structurally, unallocated credit gold. So the only way gold could be of systemic threat to the stability of the Western banking system is if the price of gold rose really high, really fast. Reset. And so here you have in 2021, by 2022, Western banks were being told by Basel, get on sides, get out of your unallocated credit gold positions. Gold's going way higher. Now you've got the Chinese getting their citizens, get out of leverage, get into physical. So look, I don't want to say like this Friday. So apparently this Friday, these regulations are taking off. Is Friday the day? I don't think so. Do I think they are communicating by their actions that sometime in the investable future, whether investable will be 6 months, 12 months, 18 months, 24 months, 36 months, sometime we are going to have a significant rise in the price of gold in a relatively compressed period of time? I think that's what the message is. And it's been set up for years. I mean, I would even go back to 2019 when the U.S. Department of Justice, under Trump, by the way, the U.S. Department of Justice filed criminal charges, RICO, racketeering charges against J.P. Morgan's gold desk, precious metals desk. Like, my father-in-law was a Teamster official. Like, RICO scared the shit out of those guys. Like, they never went after Wall Street guys with RICO. They go after RICO, saying that the gold desk was a criminal enterprise. Department of Justice words, not mine. Having worked on a sales and trading desk for 15 plus years, what that message said, if they go after JP Morgan's desk that way, what the U.S. government was saying to U.S. banks, stop manipulating gold. Stop leaning on it. We want gold higher. So you've had this daisy chain of events for 7, 10, 17 years, right? So you get a lot of people say, well, the currency system will change, but it's going to take decades. Dude, we're 17 years in. We're 2 decades in. So is this it? I don't know. Could it be it? Yeah, it could be it. But I think what the Chinese are telling you is gold's going way higher. Get out of the way. And I don't know about 3 months, 6 months, 12 months, 18 months, 12. It's coming.
Global monetary dynamics are undergoing a massive realignment as Eastern central banks challenge Western dominance over precious metals pricing. For decades, paper gold contracts were utilized by Western institutions to suppress physical metal prices and bolster fiat currencies. However, central bank strategy has radically pivoted toward accumulating physical bullion reserves while calling out paper market manipulation. By establishing local bullion pricing benchmarks and invoicing energy commodities in non-dollar currencies, emerging sovereign powers are dismantling legacy trade structures. Macroeconomic projections indicate that Western central banks will inevitably confront severe treasury market dislocations as foreign official buyers permanently cease purchasing sovereign bonds. To prevent systemic financial collapse, monetary authorities will be forced to implement aggressive yield curve control policies. This intervention will severely undermine fiat purchasing power, accelerating a multi-year global transition toward a commodity-backed neutral reserve asset. Now, let's get back to the interview.
The equities are still cheap in gold terms. Or excuse me, gold is still cheap in equity terms. Gold is still cheap in equity terms. If you look at the Dow-to-Gold's gone to 1 roughly in each of the last 2 major sort of economically painful eras, right? So the Great Depression went to 1. In 1980, Dow-to-Gold went to roughly 1. And today it's what, 10, 12 or 14? Do I think it's going to go to 1? I would sell before 1. Anything's possible, I suppose. And I want to be clear. I don't think it's going to, I think the Dow-to-Gold ratio is going way lower. And I don't think it's going to happen mostly via the Dow going down. I think it's going to happen almost exclusively by gold going up, because again, as we alluded to before, at least for the foreseeable future, stocks can't go down much until they create receipt problems, they create bond market problems. The stock market backs the treasury market through the receipt and through the consumer spending angle. And so, Dow-to-Gold has gone to 1 twice. I think it goes back in that direction. Is it 2? Is it 3? I don't know. Is it 4, 5, whatever. A lot lower from where we are today, 12, 15. And, then we sort of stop and relook. But I think, I think my base case over the next couple of years is equities go higher in dollar terms and they go lower in gold terms. China's much stronger than they were in 2002. How do you think they feel about Iran? They've got to be going, oh my God, I can't believe they're doing it again. They're going to give us another 5, 10, 20-year period of strategic opportunity because they've got this fetish about Middle East wars. The Chinese have to be like, oh my God, wow. It's very frustrating for me to just see that, how this is going to go so clearly. People are cheering the Iran war. Finally. This is what we said in friggin' 03, 04 too. You can go back and find people, Initially, I was like, oh, I believe you, government. I believe you, American government. Let's go. And, they must have WMA. My government would never lie to me. Fool me once, shame on you. Fool me twice, shame on me. I'm fool me twice. Anyway, it's a little bit of a ramble, but I think China, the more this goes on, what we've seen with China's ability to adjust, and not just adjust and thrive. I think they're like, this is great. Because what does China want? What does China want strategically, ultimately? They've been saying it since 2009. They want a new currency system. They're on the same page as Besant is now with Hamiltonian economics. They want a neutral reserve asset. What's going to happen here at the end of the day? Western bond yields are going to hit high enough. They're going to have to do yield curve control in some form, which is going to really hit these currencies. It's going to send gold to the moon, and we're going to have our new system. Look, maybe that's the plan. Hey, let's go start a war in Iran. It creates a crisis. It lets us do whatever we want domestically. And it ultimately results in a change in the currency system that now we're on board with and the Chinese have been on board with the whole time. Possible. I think it's giving them too much credit, but it's possible. Well, and it's fascinating because when that guy wrote it, a guy's named Qiao Liang, he was a colonel in the PLA, People's Liberation Army. He's now a general. So you don't go from colonel to general if what you're saying, A, they don't like, and B, isn't working. So in 2015, he gave a speech to the Chinese Communist Party senior officials in which he said, among other things, the Americans picked the wrong enemy when they tried to fight China. They don't understand what's happening here. By virtue of big data, cloud computing, etc., they are undermining the dollar with their own big tech. Because once big tech gets to the point that you can instantly settle without the dollar, if you have a hedge, and he said, yes, he said, if you have a hegemon, an empire that is based on the dollar, and then your own big tech and cloud computing, et cetera, allows instant settlement without the dollar by China and others. And he gave examples in 2014 of how much volume Baidu and Taobao and these internet applications, they were doing massive volumes 12 years ago without the dollar, off the dollar. He said, what happens to the empire that is dependent on the currency when the currency is no longer needed to settle trade? By virtue of their own cloud computing, big tech, financial innovations. He said that is the questions the Americans should be thinking about. And then the next year, he said something along the lines of, if you want to attack America, you attack the debt, cut off the financing. Well, what did China do in 2013? He said, we're done buying treasury bonds. Said, it's no longer in our interest to grow holdings of FX reserves, is what they officially said, November 2013. You can find it on Bloomberg. What they really said is we're done buying treasuries. And their holdings of treasuries haven't done anything since. And guess who has bought them? The Fed, U.S. banks, U.S. hedge funds. And what's gold done? When they said that, gold was, 1,200 an ounce, 4,200 an ounce. What's inflation in the U.S.? What's the treasury market, though, right? They're playing a longer game.
Legal precedents and technological breakthroughs are rapidly converging to undermine the long-term hegemony of the U.S. dollar. Criminal racketeering prosecutions against major Wall Street precious metals desks marked a historic regulatory shift, signaling a clear warning for financial institutions to cease artificial price suppression. Simultaneously, the global expansion of cloud computing, big tech platforms, and digital payment networks enables international trade to settle instantly without relying on dollar clearing mechanisms. While Western powers remain entangled in costly Middle Eastern geopolitical conflicts, competing sovereign nations are seizing a multi-decade window of strategic opportunity to insulate their domestic economies. Market predictions indicate that foreign capital strikes in sovereign bond markets will create severe federal debt financing shortfalls over the coming years. Western central banks will ultimately have no choice but to monetize national deficits through yield curve control, severely inflating domestic money supplies. As paper bond markets buckle under rising interest rates, physical gold is predicted to skyrocket as the premier global hedge against currency debasement. Investors who convert leveraged paper assets into physical bullion will be best positioned as the international financial system completes its inevitable transition toward a neutral, commodity-tied reserve architecture. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.